Now we're going to do a life and health topic, and today we're going to talk about dividend options. Now, when it comes to life insurance, the only type of companies that can pay dividends to its policyholders are mutual companies. You must remember that mutual companies are owned and operated for the benefit of policyholders, so they do not have any stockholders at all. So if a mutual company declares a dividend, that dividend has to be paid to the policyholders. We would have discussed the idea that dividends are never, ever, are they ever guaranteed. But if an insurance company pays a dividend to its policyholders, they are going to have different options on how to receive that dividend. These options, quite simply put, spell out CRAPO. Your choices are going to be cash, reduced next year's premium, accumulated interest, paid up addition, paid up life, and 1-year term. Each one of these is going to be triggered when the insurance company cries out, "I declare a dividend." And when they declare that dividend, then you, the policyholder, have a decision to make as to how you want to receive that dividend. So, let's do it. The insurance company cries out, "I declare a dividend." So option number 1 is cash. In fact, anytime an insurance company is going to give you money, cash is always an option. So if they declare a dividend, you can simply say, "Hey, send me the check." That'll be great. So that would be option number 1. All right, let's do it again. The insurance company cries out, "I declare a dividend." Option number 2 would be to reduce next year's premium. Instead of the insurance company sending you a check and you sending them a check for the premium, you just simply tell them, "Hey, you hang on to that check, I'll send you a check for the difference and everything is good to go." This saves a lot of time, a lot of hassle, and a lot of mail. So you can reduce next year's premium. You tell them to hang on to the dividend, apply that to your premium, and you'll send them a check for the difference. That's how it works. All right? Once more, the insurance company cries out, "I declare a dividend." The third option you're going to have is to accumulate at interest. Now, this dividend option is kind of tricky because what you're going to tell the insurance company to do is to hang on to that dividend and let it accumulate interest. Now, dividends are paid without any taxes whatsoever because they're not a return on investment, they are a return of unneeded premium. But this dividend option, accumulated interest, does incur a tax event. Because what will happen is as that dividend accumulates interest, at the end of the year, you'd have to tell the IRS how much interest you accumulated, and then you'd have to pay tax on the interest. Remember, you'll never pay tax on the dividend itself because the dividend is paid tax-free. But if you tell the insurance company to hang on to the dividend and let it accumulate interest, that will incur a taxable event to you because you will then have to pay tax on the interest itself. And you have to pay tax on that interest in the year that it is incurred. So it is not a tax-deferred growth of money. You pay tax on the interest as it is incurred. So that one is kind of tricky. All right, let's move on to the next one. The insurance company cries out, "I declare a dividend." And so your next option would be paid up addition. What a paid up addition really is it's a single premium whole life policy. You take the dividend and have the insurance company simply buy a single premium whole life policy. What does that mean? Well, first of all, what is whole life? Whole life is a policy that lasts your whole life. The premium never changes and it generates cash value. And that cash value is absolutely positively guaranteed. With this, a single premium whole life policy, you will never owe another dime on that policy. The policy will last until age 100 or whenever you die, whichever one occurs first. And it develops cash value. So a paid up addition is just simply a fancy way of saying a single premium whole life policy. All right, let's do the next option. So the insurance company cries out, "I declare a dividend." So your other option would be paid up life. Now with whole life policies, you pay the premium generally over a period of time. Some policies require you to pay every year that you're alive, up until age 100. Some policies are ending at age 65, where you stop paying premium by the time you reach 65. Some are set up that you only pay for 10 years or 15 years or 20 years. With this option, with the paid up life, what you're going to do is apply the dividend to your premium. And what it does then is it compresses the premium payment. So if you had to pay your premium to age 65, you could take that dividend, apply it to your premium, and now you might be able to stop paying premium at age 63 or age 62. So it doesn't increase the death benefit like a paid up addition, but what it does do is compress the premium payment so that you don't have to pay for as many years. Now, one last option. The insurance company cries out, "I declare a dividend." And so your last option would be a one-year term policy. Now, you might find this hard to believe, but a one-year term policy only lasts for 1 year. Now remember, with term insurance, the only way you collect on a term policy is if you die, and you have to die during the course of the term. So this one-year term policy is only good for 1 year. If you don't die by the end of the term, you don't get paid. So one-year term is the last option. So once again, if you have a policy with a mutual company, it is possible that they may pay a dividend. And if they do, they're going to pay it to you, the policyholder. What are your options when the insurance company cries out, "I declare a dividend"? Your options are simply crapo. You have cash, reduced next year's premium, accumulated interest, paid up addition, paid up life, and one-year term. Those are your dividend options. I hope this tip helps you pass the state exam.